recent reports are coming out saying that homes are staying on the market longer than they previously have been, and we're even seeing some markets where some home prices have dropped. So there's just some pretty attention-grabbing headlines. When you get into the data behind it, it's not that the market is crashing or that there's a big bubble that's bursting. However, what this does mean as we're starting to shift from a seller's market to a balanced or even a buyer's market is that we may see more homes not appraising for the contract price, right? So sellers are trying to get top dollar, buyers are trying to get a deal. And for a long time, just because of the demand and because of how home prices have been going up, we really haven't run into that. But I do think that we may start to see some more low appraisals coming in. Low appraisals, meaning that they didn't meet the sales price. And wanted to talk with you through how that gets handled and what we're going to do about it. So if we haven't met, I'm Rebecca, aka the Mortgage Mentor, and I enjoy explaining everything about real estate and mortgages and making whatever's complex simple so you can make smart decisions. Be sure to like and subscribe if you're into that. So the first thing to keep in mind is that a lot of times when we're seeing a home not appraised, it's going to be for a couple reasons. One of the first ones is that sometimes in order for the buyer to get the winning offer, they're offering the highest price or the most aggressive. The other thing is that sometimes if it's in an area where there has not been a lot of sales, there might not be a lot of comparable sales for the appraiser to use that supports the value. So a buyer may be willing to pay it, but without the support of the market to say, yes, this particular home in this particular size, this number of bedrooms, bathrooms, features, all those kind of things, if it can't be supported by a recent sale or a sale that's close enough to the home that you're buying, then the appraiser may not really have that data supporting the sales price and the appraisal comes in low. It's very common when this happens that buyers think that the deal is going to blow up, and it doesn't have to. So there are a couple strategies that we can use. Some you might be aware of, some that are a little bit more creative, but that I've been able to use with clients to help make sure that they still get what they want, which is ultimately the house at a reasonable price. One of the first things that you can do is do what's called a reconsideration of value, or an R.O.V. And what an R.O.V is where your realtor, sometimes with the help of the listing agent, but a lot of times it's the buyer's agent, will put together and put on a chart comps or the comparable sales that they used when they were working with you and advising you on the offer price, the homes that they saw that felt like it supported the price that was being offered. So sometimes what happens is, because again, an appraisal is an opinion of value. It's a little bit science, a little bit data, a little bit art. So there is an opinion factor in there of to say, well, this home A, is a better comparable sale than home B. And it depends. A lot of times that is going to be one of the first things that we do is get that R.O.V where buyer's agent is saying, hey, these are the homes that I use to support the sales price that is sent over to the appraiser. The appraiser reviews it and responds either with, yeah, you're right, let's go ahead and add that comp in. Or they might say this comp was not used for X, Y, and Z reason. Maybe you're buying a 2-story home and one of the comps is a split level, or maybe it's further away, or it's in a community that has different amenities, or maybe even sometimes a school district. All the nuances that can factor what a home is worth. If that R.O.V comes back and the value is not changed, then a lot of times what will be suggested is going to the seller and saying, hey, Mr. and Mrs. Seller, the appraisal came in $5,010 short of the offer price. Are you willing to amend the contract and come down to the appraised value? And sometimes that happens. Sometimes what happens is that you might meet in the middle, right? So let's say that there was a $10,000 shortage in the value compared to the offer price. So that might look like then you both, maybe putting $5,000 more, maybe $5,000 more down as a down payment, and then the seller coming down $5,000. If there was a situation where included with the offer, if the sellers were perhaps offering closing costs, which is going to come off their bottom line, then they might say, well, we'll drop the sales price to the appraised value, but we're not going to give the closing cost anymore, because then they're kind of being double hit, obviously, for what they're going to net from the property. So there is an opportunity there to potentially renegotiate the sales price or the terms of the contract to account for the appraised value. The last option, and this is something that really only works with conventional loans, not so much with FHA, not so much with VA, but with conventional, one of the things to keep in mind when we're looking at a loan is going to be sales price or the appraised value, whichever is less. That's going to be the basis of the loan. For super round numbers, let's say that you're buying a house for $100,000. Who wouldn't want that? But let's say that you're buying a house for $100,000 and you're putting, let's say, 10% down, right? So your loan amount's going to be $90,000. If the home comes in lower than $100,000, let's say it's $95,000, then we are going to be calculating the loan off of 95%. If your down payment is at least the minimum that's required, and for conventional, it's either going to be 3% if you're a first-time home buyer or 5% if you're a repeat buyer. If the sales price compared to your loan amount still accounts for you meeting that minimum requirement for the 5% down, you don't really have to change anything. So from that standpoint, if we're thinking about 90 compared to 95, you might have to put a little bit more down, but it's not going to be the same as having to put, let's say, an extra $5,000 down. There is some variance there, and it gets very nuanced compared to what was the original plan, what was the original sales price, the original loan amount, and then the appraised value. But as long as with conventional, you're meeting that minimum payment required, and that can also work with FHA, but most of the time people with FHA are putting the minimum 3.5% down, so they're not putting more than that down. But if you are putting more than minimum down, and now with the appraisal, you're still at least meeting that minimum requirement, you don't have to change the price of the home, so the seller's happy. The loan amount doesn't have to change, so you're not coming out of pocket with anything extra. The only thing that might change would be the mortgage insurance. If you're going from, say, a 90 to 94.99 loan to value, loan to the sales price or loan to the appraised value, and then you're exceeding that, or it's changing kind of those buckets because mortgage insurance it's rated in 5% buckets down to, and when you put 20% down, you don't have it anymore. So if it changes kind of that bucket that you're in, then that will change how much mortgage insurance is needed. So that does change your payment, but it doesn't change your out of pocket. It doesn't change what the seller is going to net. The other thing that I see is sometimes where people are putting at 20% down. So they're putting 20% down so they don't have mortgage insurance, and then the home doesn't meet the sales price. Another thing that we can do other than maybe paying monthly mortgage insurance is that we can do what is called a one-time mortgage insurance premium. So if that happens, if your original plan was to put 20% down and now the house slightly didn't appraise and it puts you over that 80% loan to value, you don't have to necessarily pay mortgage insurance monthly for years. You can do a single mortgage insurance premium, and it's a one-time payment that is made at closing. So let's say I just had a scenario with a client that we did this, and the total needed for closing was maybe around $2,000. And so what they were able to do was to, instead of raising the payment with the monthly mortgage insurance or having to change the sales price or her having to change her down payment, loan amount, and all of those things, what she did was opt for that single mortgage insurance premium and also negotiated for the seller to give her a seller credit to cover it. So she was happy because it really didn't change any of her numbers. Her seller was happy because it didn't appraise. They thought that it might not appraise. They didn't really come out of pocket as much as they would have dropping the sales price. Their buyer was still happy, still moving forward, and we were able to close on time. So the biggest message that I want you to know when it comes to appraisals is if it doesn't appraise, it does not mean that all is lost. There are other options that we can investigate, that we can use, other tools, other strategies to keep everything together, still wind up at the closing table where you're happy with what you're buying and you're happy with what it took to buy it. Please like, comment, and subscribe. And if you have any questions, I'm always here to help. I'll see you next time.